Chapter 3. The Paradox of McKinsey and Sea Urchins. Moreover, when a modification of structure has primarily arisen from the above or unknown causes, it may at first have been of no advantage to the species, but may subsequently have been taken advantage of by the descendants of the species under new conditions of life and with newly acquired habits. Charles Darwin, On the Origin of Species, Chapter 6, Difficulties of the Theory. We rarely use much debt, and when we do, we attempt to structure it on a long-term fixed basis. We will reject interesting opportunities rather than over-leverage our balance sheet. This conservatism has penalized our results, but it is the only behavior that leaves us comfortable considering our fiduciary obligations to policyholders, depositors, lenders, and the many equity holders who have committed unusually large portions of their net worth to our care. Warren Buffett, Annual Letter to Shareholders, 1983. The world is shrunk into a few square miles of New York, the filth of Mumbai, the art of Berlin, the style of Paris, the food of London, the bustle of Tokyo, the gaudiness of Shanghai, the rudeness of Delhi, the shopping of Singapore, the decadence of Monaco, the chaos of Cairo, and the magnificence of its own. I love it. This is why we hold Nalanda's annual investor meeting in the city every year in late June. When my son was young, why did they grow up? He had two favorite spots in New York. Over time, they became mine, too, the Central Park Zoo and the FAO Schwarz toy store on Fifth Avenue. Our favorite activities there were petting the baby animals and dancing on the giant piano. I remember FAO Schwarz less for its dazzling array of toys, many of which we bought over the years, and more for being soaked in wonder and amazement. There were magicians, Rubik's Cube artists, giant cuddly pandas, otherworldly jugglers, and, on one occasion, a group of singers and dancers who rivaled Broadway performers. Growing up in semi-urban India, I had never been to a toy store before, and I am not sure to this day if our visits to this iconic institution were more exciting for my son or me. After our 9th annual meeting in 2016, I remember walking up Fifth Avenue waiting to be mesmerized by something new in the store. But it wasn't there. A quick Google search on my phone sank my spirits. The store had shut permanently. How in the world could this have happened? Why would the store be closed when it was almost always teeming with customers and there never seemed to be enough cash registers? The Mystery of McKinsey. McKinsey, the global strategy consulting firm, decided to enter India in 1992 following the beginning of the economic liberalization of the country in 1991. It decided to hire fresh interns from 2 MBA schools in the country. India did not have strategy consulting firms in 1992, and none of us knew anything about the industry. Remember that there was no internet then, so we could not even do basic research on the industry or the company. Our professors, too, were clueless. I was a final-year MBA student in one of those 2 schools. The firm, as it is called by insiders, for some inexplicable reason had decided to pay more than twice the next highest-paying company, Citibank. The entire MBA class applied, including me. No one cared what McKinsey did, the lure of the lucre was too strong to resist. I happened to be at the right place at the right time, isn't that life? And was one of 5 MBA graduates hired. I was there for about 6 years. McKinsey is a great institution. Although life was quite tough, too many PowerPoint presentations and too many air miles, I enjoyed the competitive camaraderie, the satisfaction of working with CXOs, and its global oneness. I worked in 4 different international offices in 6 years. Having spent many years in the outside world after my departure from McKinsey, my admiration for the firm has grown over the years as it has continued to dominate its industry. McKinsey was founded in 1926 by James O. McKinsey, but the man who deserves the lion's share of credit for building the firm to its current glory is Marvin Bower, who joined in 1933. He transformed the small engineering and accounting firm into the management consulting powerhouse it is today. In the 90-plus years since McKinsey's founding, the firm has suffered cataclysmic internal and external shocks. Let's start with some of the external shocks first. The Great Depression, the Second World War, rapid decolonization, the Cold War, the oil shock, multiple recessions in the United States and other major economies of the world, the population explosion, massive poverty reduction, the creation and destruction of conglomerates, the hollowing out of manufacturing in the United States, the rise of China, the exponential increase in computing power and communications technology, including the Internet, the global financial crisis, and the COVID-19 pandemic, to name a few. As the external world was undergoing rapid change, McKinsey itself worked through a few internal shocks. The transfer of power from Marvin Bower to the next generation in the late 1950s repeated internal pressures for the firm to go public, including when I was there, the imprisonment of Anil Kumar and Raja Gupta. Its massive expansion into new geographies and industry segments over the years, its dubious fees arrangement with the South African utility Eskom, and the $600 million settlement for its work with the opioid manufacturer Purdue Pharma. Not many of McKinsey's competitors survived the rapid pace of change in the rough-and-tumble world of consulting, remember Monitor or Booz. On the other hand, McKinsey has not only survived but also continued to prosper doing exactly what it has always done. Act as a trusted advisor to the CXOs. The firm at its core has remained stubbornly immune to external and internal shocks. But here's the funny, even weird reality. The firm, while remaining robust to change, has also changed dramatically over the past decades. It started in the United States but is now also in Cairo, Casablanca, and Chengdu. It primarily offered strategic consulting until the 1990s but has expanded into operational and technology consulting. It used to serve mostly manufacturers in its early days, but you will now find it crawling all over Google, Facebook, or a hot new startup in the Valley. In my time, it rarely hired laterally, but according to friends who are now senior partners, the company now hires hundreds of experienced industry specialists. Living organisms are highly robust. MBA degrees, management seminars, best-selling business books, and corporate titans all seem focused on ensuring that companies adapt to change and evolve into a better version of themselves. If one could bottle up corporate obsession, the label on this bottle would declare, "How do we change faster, better, and easier?" I beg to differ. The question that should be on the minds of business leaders and investors is almost the exact opposite. How do we change without changing? Let's turn to evolutionary biology to understand why. Biologists have always been aware of a strange conundrum of the living world. Organisms, animals, plants, algae, fungi, and even bacteria are incredibly complex. But they are not delicate. On the contrary, they have survived and thrived for hundreds of millions of years, and in the case of bacteria, billions of years, despite continuous assault from the turbulent and dynamic external environment. Even their internal environments seem to be constantly revolting against them in the form of unceasing mutations. Despite these external and internal perturbations, not only have living things survived, but they have also successfully diversified into millions of species. They occupy almost every available niche on our planet, from icy glaciers to boiling deep-sea thermal vents. One of the greatest wonders of this world is this. Living things are highly resistant to internal and external changes while simultaneously possessing the ability to evolve. Let me call this ability to function well despite internal and external disturbances robustness. If the first proto-single-celled organism were too robust, it would have remained unchanged over 3.5 billion years and we would not have had mushrooms or meerkats or Manhattan. On the other hand, if it were not robust enough, it would have gone extinct quite quickly in the volcanic and violent days of the early Earth. You and I and all the living things we see around us are here because organic life has been able to strike a delicate balance between maintaining the status quo and evolving when the need arises. How does this happen, and what can we learn from it as investors? This dual trick of changing while remaining unchanged results from two separate but intimately linked phenomena. First, living systems are robust at multiple levels. Second, this robustness helps neutral mutations become the source of future innovations. What multiple levels? And what is a neutral mutation? Does this sound like gobbledygook? Let's start at the start. Our mother, our creator. The DNA deoxyribonucleic acid molecule. The DNA molecule in any organism, be it a plant or a human being, serves two key functions. It carries information to build the body parts of an organism, for example, skin, kidney, petals, leaves, and is transmitted to offspring. DNA-based genetic code determines who we are and what our children will be. The DNA molecule is shaped in the form of a double helix and consists of 4 types of units called nucleotides. A. Adenosine, C. Cytosine, G. Guanine, and T. Thymine. As shown at the top of Figure 3.1, a gene comprises a chain of nucleotides that can number from a few hundred to a couple of million. I have shown 9 nucleotides here for illustration. These DNA nucleotides always exist in pairs called base pairs. The T nucleotide always pairs with A and the C nucleotide always pairs with G. Figure 3.1 shows just 1/2 of a base pair with the sequence ACGGATCGA. The DNA of all organisms comprises the same 4 nucleotides, A, C, G, and T. Just think about it for a moment. Orchids and orangutans share these same 4 nucleotides in their DNA code, they are just arranged differently in each. Human beings have 3 billion base pairs of nucleotides. Not in our whole body. In almost every cell of our body. I find this quite astounding. Remember that the next time you are packing a tight suitcase. And just because we rule the world does not mean we have the largest genome. The size of the human genome is quite unremarkable. The lowly amoeba dubia, a single-celled organism, has 670 billion base pairs in its DNA that makes for a genome about 220 times larger than yours and mine. For this discussion, let's focus just on genes that manufacture proteins. We are all essentially a bag of proteins. Proteins build bodies and regulate, defend, and monitor their functioning. Our body parts differ because they have different proteins. For instance, keratin makes our skin, hemoglobin carries oxygen in our blood, and proteins called immunoglobulins defend us from parasites. DNA makes protein in a 2-step process. The first being transcription and the second translation. First, a single strand of DNA with a long chain of A, C, T, and G nucleotides gets transcribed onto a complementary messenger RNA ribonucleic acid sequence called mRNA. Yes. This molecule is the basis of the COVID-19 vaccines made by Pfizer BioNTech and Moderna. Thus, the DNA sequence ACGGATCGA shown in Figure 3.1 will get transcribed to the mRNA sequence UGCCU-AGCU. What is this new letter, U? In the transcription process, the DNA nucleotide A adenosine gets transcribed onto the mRNA nucleotide U uracil and, as described earlier, C pairs with G and T with A. A DNA sequence has produced a corresponding mRNA sequence. What now? In the second step, a sequence of mRNA molecules is translated into a sequence of amino acids that synthesize a protein. mRNA is a single-stranded molecule and it comprises codons made of 3 nucleotides that code for specific amino acids. In the mRNA sequence UGCCU-AGCU shown in Figure 3.1, the first codon, UGC, makes the amino acid tyrosine, the second codon, CUA, codes for leucine, and the third codon, GCU, codes for the amino acid alanine. A sequence of amino acids folds into a protein. Voila! DNA made mRNA, which then made a protein. If you are a biologist, I hope you haven't had a heart attack. I know that these few lines don't fully capture the complexities and nuances of the working of the universal genetic code. We haven't covered RNA, tRNA, not coding DNA, or enzymes. But hey, this is not a biology textbook, and I am simply trying to lay the basic groundwork to make sure we all have the same basic understanding of genetic code before moving ahead. To comprehend the robustness of living organisms at multiple levels, let's start at the bottom, the universal genetic code. The genetic code is robust. As mentioned, a codon comprising 3 bases creates an amino acid. Thus, the codon AGC creates the amino acid serine and GGC makes glycine. Since any of the 4 nucleotides A, C, U, or G can occupy one of the 3 bases, there are 64 possible amino acids 4 by 4 by 4. However, only 20 exist in nature. How so? This is because 2 or more codons can code for the same amino acid. For instance, GGU, GGC, GGA, and GGG are all glycine. Thus, any mutation on the 3rd position of the codon with the first 2 positions GG will always form glycine. These are called synonymous mutations. The formation of glycine is thus highly robust to mutations on the 3rd base. Overall, the universal genetic code has funneled down 64 possibilities to just 20 through this type of synonymous mutation. Synonymous mutations are just the first level of robustness. Scientists have found that translation errors at the point of codon formation are most likely at the 3rd position and least likely at the 1st position. Amazingly, the degree of robustness is also highest at the 3rd position of the codon, as in the earlier example of glycine. Thus, even though the 3rd position is most error-prone in translation, it will have no impact on the type of amino acid formed. In other words, evolution has ensured that the genetic code is extremely robust to mutations and translation errors. Isn't that cool? Proteins are robust. Let's now go one level beyond the genetic code to see if proteins are robust to changes in the sequence of amino acids. As discussed, a protein is a large molecule made up of a certain amino acid sequence. They are in all living organisms and are directly involved in all the chemical processes essential for creating and sustaining life. Thus, given the stability of life forms, one would expect proteins to show a high degree of robustness, and that is exactly what we see. There are 3 types of protein robustness. First, scientists have found that the function of proteins is unaffected by the vast majority of amino acid changes. For example, the bacteria E. coli carries a protein called beta-lactamase, which confers antibiotic resistance. This protein has 263 amino acids, 84% of which can experience mutation, that is, they can be changed into another amino acid without changing the enzyme's basic function. Ponder that. It would be like making 84 mistakes on a math exam comprising 100 questions and still getting an A. The second type of robustness results from proteins with similar functions and structures being able to be made from different amino acid sequences. For example, myoglobin and hemoglobin are oxygen-binding proteins in vertebrates, and they have many distant relatives in invertebrates, like crabs and spiders and plants. The 3-dimensional structure of whale myoglobin and clam hemoglobin can be almost perfectly superimposed. Despite this uncanny structural and functional similarity, the amino acid sequences of the two are very different. Only 18% of the amino acids of the whale myoglobin and clam hemoglobin overlap. Third, scientists have found that the vast majority of amino acid sequences fold into very few structures. No, I really mean it, very few. Let's see how few. A small protein may have 100 amino acids, and so the number of possible protein folds is 20,100, which is more than the number of atoms in the universe. And how many proteins exist? About 10,000 or 203. Thus, protein structure and function are extremely robust. The body is robust. Let's now go one level up from proteins to the body by taking the example of sea urchins. Sea urchins evolved 250 million years ago and comprise about 1,000 species. For now, we will focus on just 2 found in shallow waters in Australia: Heliosidaris tuberculata and Heliosidaris erythrogramma. Let's call them species T and E. Their body plans are conserved, in other words, they look the same but have dramatically different modes of development. T produces larvae called pluteus that bear no physical resemblance to the adult, and these free-swimming pluteus feed on plankton as they grow into adulthood. E, on the other hand, develops directly from an egg with no larval stage in between. But T and E are quite closely related and diverged only about 5 million years ago, almost the same time that chimpanzees and humans diverged. It would be as if chimps produced larvae that did not look like adult chimps. The entire development programs, the shape and size of eggs, the location of cell formation for various body parts, the activation of genes that control development of these 2 species differ so significantly that it is almost unbelievable that the 2 species have a common ancestor from only 5 million years ago. Despite these massive developmental changes, if you do a Google search for images of T and E, you will notice that they look almost the same. How have the sea urchins maintained their body plans while changing many fundamental aspects of their development? And what have they achieved by maintaining highly robust body plans while evolving drastically different routes of development? We will get to these questions in a moment, but for now let me summarize what we have learned. We have seen that the stability of living organisms and species is maintained through robustness at multiple levels. At the levels of genetic code, proteins, and even body plan. For the sake of brevity, I have chosen to omit details of robustness at many other levels. Changes in the secondary structure of RNA, changes in the regulatory regions of a gene, and drastic changes in enzyme activity, just to name a few. A mutation changes the DNA sequence of a gene? No problem. It produces the same amino acid. The amino acid sequence changes owing to mutation or recombination? No problem. It produces the same protein. There is a change in the arrangement of proteins? No problem. The same enzyme activity continues. And so on. Living things are built to be resilient and resistant to change. The evolution of evolvability. This gets us to the paradox I mentioned at the start of the chapter. Given multiple levels of robustness, how in the world do species evolve? Should they not stay fixed? What propelled bacteria to become bonobos? The short and incredible answer is that robustness itself leads to evolvability. We need to make a brief foray into one aspect of the history of molecular biology to unravel the paradox. In 1968, the Japanese geneticist Matu Kimura proposed the neutral theory of molecular evolution. Kimura contended that most changes at the level of DNA and amino acids do not impact the function of a molecule and hence the organism's ability to survive and reproduce. He contended that a small number of mutations are favorable and natural selection preserves them. Some mutations are rejected because they are harmful, but most mutations don't really affect the organism. According to Kimura, most mutations are neutral, which causes robustness in the organism. So how does neutral mutation lead to evolution? While a neutral change does not alter the primary function, it can alter a secondary function, thereby becoming the source of a future innovation. Let's say gene A has primary function F. Owing to a mutation, gene A becomes gene B, but since it's a robust system, gene B continues to perform function F. But gene B affects a secondary function Fs. Fs does not alter the fitness of the organism but can be used by the organism's descendants for a completely new function, thereby leading to evolution. Thus, although the genetic code was robust because gene A changing into gene B did not affect function F, the addition of function Fs allowed the organism to evolve. In a robust biological system, evolvability comes free. Let's now return to the sea urchin example. T and D have maintained their body plan's robustness while changing their development cycle through neutral mutations over millions of years. For example, 16 of the 32 cells of the T embryo become the ectoderm, the outer layer of skin, whereas 26 of the 32 E embryo cells do so. The sea urchin's body structures have stayed robust to multiple changes in embryonic development. As a result, they have exploited a completely new ecological niche and a novel way of life. For example, E is abundant in deep seas and polar latitudes where T cannot survive. This is because E develops directly and does not need to go through the larval stage critically dependent on plankton for survival. Something similar has been happening at McKinsey over the past century. Today's McKinsey bears no resemblance to Marvin Bower's McKinsey in terms of geographical presence, organization processes, type of client work, and breadth of expertise. But at some fundamental level of culture, oneness, problem-solving, and working with CXOs, the firm has remained stubbornly Boweresque. It has changed without changing. This is what we seek as owners in our businesses, the ability to keep evolving while staying robust. Businesses must be robust to evolve. Let's recap our journey until now. We have eliminated serious risks, Chapter 1, and have shortlisted businesses based on our OCE, Chapter 2. Now we need to select companies for their robustness. Here are some learnings we have internalized at Nalanda. Robustness takes many forms. How does an investor measure robustness in a business? I wish I had a simple quantitative answer. I don't. Like almost everything in investing, the solution is somewhat subjective, somewhat vague, and somewhat controversial. But it works for us. The best way to understand robustness is to contrast the two extremes listed in Table 3.1. This is not an exhaustive list, but I hope you will get the general drift of what I mean when I say a business is robust. A robust business lies on a continuum between the two poles described in the table with a bias toward the left side. You will notice that, unlike in Chapter 2 where we use the quantitative criterion of our OCE to select businesses, many factors contributing to robustness are qualitative. Also, almost no business falls entirely within the left or right column in my experience. Robustness is not a black and white measure. Thankfully. Or else, what would separate a good investor from a great one? Table 3.1. Examples of robustness in a business. Most robust. Has delivered high historical ROCE over a long period. Has a fragmented customer base. Has no debt and has excess cash. Has built high competitive barriers. Has a fragmented supplier base. Has a stable management team. Industry is slow changing. Least robust. Has made operating losses for most or all of its history. Is dependent on very few customers. Is highly leveraged. Has been unable to keep competition away. Is dependent on a few suppliers. Management turnover is high. Industry is evolving fast. Different investors attribute different weights to the factors listed in Table 3.1. For instance, many investors do not consider customer concentration to be a problem for a business. We do. We took advantage of these contrasting opinions a few months after the inception of Nalanda. WNS is an Indian business process outsourcing BPO company with a U.S. listing. The leading BPO companies like WNS provide many mission-critical services to their clients of a quality and at a price that can typically not be matched by the company's internal teams. For example, they help their clients close the books of accounts, manage payables and receivables, perform timely consumer analytics, process mortgage applications, and address customer issues. We had been tracking WNS since we started Nalanda in 2007. Despite its high ROCE, zero debt, strong competitive advantage, and stable management team, we did not like the business because of its dependence on just a few customers. In 2006, WNS's top 5 customers accounted for 41% of revenue, and in 2007, this number had jumped to 55%. We worried that the company's robustness was low and declining. But the markets did not seem to care, and WNS's stock price reached $35 by the middle of 2007. WNS lost a major client in the latter half of 2007, and another client threatened to terminate their agreement. This wasn't great news in the short term, and the markets punished WNS severely. The stock crashed to $13 in early 2008. However, we concluded that the company would become more robust with a more fragmented customer base. We bought about 6% of the business from January to March 2008. Fast forward 13 years, and in 2020, WNS's top 5 clients accounted for only 25% of revenue. What was supposedly lousy news in 2007 looked pretty good in 2020. We assess evolvability indirectly by measuring robustness directly. As permanent owners, we Nalanda folks are hungry for companies that can successfully implement neutral strategies to evolve and adapt to a changing environment. We want evolvability. Correction. We need evolvability. Having invested, we need the business to survive the onslaught of AI or other technologies, to upstage its increasing online and offline competition, to withstand multiple recessions, to conquer the adverse effects of climate change, to survive management turnover, and much more. We need it to be able to adapt. However, just as evolutionary biologists struggle to measure evolvability, I haven't yet figured out a reliable way in advance to directly assess a company's propensity to adapt to a changing world. Many investors contend that management interviews and discussions are an excellent way to assess the future adaptability of a business. Maybe. I consider such interviews a waste of time, but more on that later in Chapter 7. But there is an indirect, and I would argue a reasonably reliable, path of satisfying my need. It is by measuring the robustness of an organization. Robustness lays the groundwork for evolution in living things. It does the same in businesses. Robustness is a necessary, though not sufficient, requirement for businesses to evolve successfully. In a robust business, just as in a living organism, evolvability comes free. Take the example of 2 businesses in an industry. Company A is the leader, and on sales of $100, it earns a margin of 20%. Let's assume its capital employed in fixed assets, receivables, and inventory is $50. Company A's ROCE is quite healthy at 40%, 100 times 20% divided by 50. If a company's growth is lower than its ROCE, it will also keep generating free cash flow, and so Company A has no debt. Company B is a weak player in the industry with half the sales of Company A, $50, and a margin of 15%. Since it does not have enough bargaining power with suppliers who demand early payment or customers who pay late, its capital employed is the same as that of Company A, $50. Company B's ROCE is 15%, 50 times 15% divided by 50. Company B has a debt of $10, which is not much given its operating profit of $7.50, and its cost of debt is 5%. Thus, both are earning decent ROCE and have a reasonably strong balance sheet. Company A is better, but Company B isn't too bad. All seems fine. Until it's not. COVID-19 strikes and the country goes into a lockdown. Sales at both companies fall by half, and so do the operating margins. Company A, being a leader, can collect cash and liquidate inventory so that its capital employed falls to $25. Company B, on the other hand, while suffering the same drop in sales and margins as Company A, is rebuffed by its customers while asking for money and is also unable to sell its finished goods in a demand-poor environment. Its capital employed stays flat at $50. Company A's ROCE is now 20%, 50 times 10% divided by 25, and Company B's is 4%, 25 times 7.5% divided by 50. Thus, even during the pandemic, Company A earns a respectable ROCE, allowing it to invest in growth. Fortified by its ROCE of 20%, Company A can also borrow in the market if it needs to, since the cost of debt is just 5% and the company is debt-free. From being comfortably mediocre during the pre-pandemic era, Company B risks oblivion because it no longer has the money to invest in production, marketing, and distribution. At 4% ROCE, it would struggle to pay its debt at 5%. Given its precarious balance sheet and declining profits, lenders would also hesitate to lend it more money. At least in the near term, a likely outcome is that Company A gains market share and Company B further loses its position. Since Company A had a higher degree of robustness owing to its high ROCE, it could adapt and evolve in an adverse external environment. What I have outlined is not a theoretical construct. We have seen this story play out in many of our businesses. When the pandemic began, the general opinion was that all Indian businesses would suffer. Sharp stock market declines in March and April 2020 mirrored this opinion. However, as the months passed, the differences in the impact on the business of companies with differential degrees of robustness became quite stark. During and after the COVID crisis, we have seen these divergent outcomes play out across many of our companies and industries, be it paint, innerwear, air conditioners, tires, pipes, or batteries. One of the best-run companies in our portfolio is Page Industries, which we were very fortunate to buy a few days after the collapse of Lehman in late 2008. Page is the exclusive licensee for the Jockey brand in India and is the largest seller of innerwear in the country. Page aggressively launched new products during the pandemic and opened new stores while many of its competitors either vanished or were significantly weakened. There are 4 listed innerwear companies in India, the other 3 being Maxwell, Rupa, and Lovable. Page's market share among its listed peers in December 2018 was already relatively high at 66%. However, by December 2020, Page's market share had grown to 70%. We don't have data for the dozens of unlisted companies, but from anecdotal evidence and feedback from industry insiders, it appears that Page's market share gain over this group during the pandemic has been even greater. I believe Page's robustness was a significant, if not the primary or only reason for its continued success during the crisis. Let's see how Page scores on the various factors contributing to robustness listed in Table 3.1. For the year ended March 2020, Page's ROCE was 63% and it was debt-free. It has highly fragmented customer and supplier bases. In my opinion, it has built a deep and wide moat by investing in brand and distribution over 25 years. It has had the same owner since 1995. Its industry is changing very slowly, with the top players remaining the same for more than a decade. The greater the robustness, the greater the evolvability. We demand multiple levels of robustness in our businesses. There is an unbroken chain of life between us and our last universal common ancestor. Scientists call it Luca, 3.5 billion years ago. Every part of this unbroken and evolving lineage has had robustness at multiple levels. Genes, proteins, and body plan, to name just 3. In a not dissimilar manner, I have discovered over more than 2 decades of investing that more levels of robustness lead to more evolvability. Let's revisit Table 3.1, which lists 7 factors of robustness. As I have mentioned, there are more factors one can conjure, for example, propensity for M&A, governance, but let's stick with these 7 for now. My aim is to point you in a certain direction, not to spoon-feed. We want our companies to tilt toward the left side of Table 3.1 across all factors. Thus, we want the business to be robust at the level of our OCE and concentration of customer base and degree of leverage and strength of competitive advantage, and so on. Is this asking for a lot? You bet. We are permanent owners, the key word here being permanent. If a business can't last permanently, we don't want to own it. Without several levels of robustness, how will we be sure that the business will survive over the long term? I wish I could categorically answer the question, is this a robust business? As a practicing investor, I know that assessing robustness is a matter of judgment and that there is no shortcut to this process. I have arrived at a certain heuristic after many years of investing. There clearly are black and white extremes to robustness, example, a business with just 2 customers, but in many, maybe even most, businesses it is the gray zone that stares at us. For example, is a company with a debt-to-equity ratio of 2.0 robust? Probably not. What about a ratio of 0.2 or 0.5? Maybe. For me, the answer depends on the other factors of robustness. Almost all the companies in our portfolio are debt-free. Still, in 2010 we invested in India's leading plastic pipes business used in homes and agriculture, Supreme Industries, whose debt-to-EBITDA ratio was 0.6. Not high, but not zero either. Despite the company having debt, which was small to begin with, we concluded that the company was robust because it was the clear industry leader, had been gaining market share over its competitors, had a return on capital of more than 30%, had successfully designed and launched many products over the past decade, had thousands of distribution points across India, was able to negotiate the best terms with its suppliers, and had not wasted time and money on unnecessary acquisitions. It was not perfectly robust, but it was resilient enough. Today, the company is debt-free and continues to be the industry leader by a wide margin. The more levels of robustness, the more we salivate. Highly robust businesses evolve by taking calculated risks. As we have learned, neutral mutations make an organism robust while simultaneously planting the seeds of evolution. In the business world, neutral changes may not have a short-term impact but may be transformational over the long run. The corporate phenomenon equivalent to biological neutral mutations can be summarized in 2 words: calculated risks. There are millions of small businesses across the world that are incredibly robust but will stay small. And then there are businesses that test the limits of robustness and implode. The former risk nothing and the latter risk everything. The Goldilocks zone between these 2 extremes is what I call calculated risk. It is the degree of risk that makes managers uncomfortable, but not too much. It compels the organization to innovate, but not too much. It forces the business to invest, but not too much, and it adds areas of potential growth, but not too many. To me, the company that best demonstrates calculated aggression and risk-taking is Walmart. Small digression. Let's see if you know the answer to this question. What was Sam Walton's age when he founded Walmart? If your answer begins with a 1 or a 2, your answer was the same as mine. And like I was, you were wrong. Sam Walton was 44 when he opened his first Walmart store in 1962 in Rogers, Arkansas. Walmart became Walmart in 2018. Not all the great founders of the modern era are from Silicon Valley, not all of them were hard-charging teenagers, and not all of them wanted to change the world. After graduating from college, Walton started in sales at J.C. Penney in 1940, then enlisted for the war in 1942. In 1945, he started managing a franchise Ben Franklin store in Newport, Arkansas, where the population was then 7,000. By 1950, he was running 2 stores in Newport and had achieved reasonable success by experimenting and innovating. One of his innovative ideas that had been a massive hit with his customers was an ice cream machine. As he writes in his autobiography, every crazy thing we tried hadn't turned out as well as the ice cream machine, of course, but we hadn't made any mistakes we couldn't correct quickly, none so big that they threatened the business. Could there be a better definition of calculated risk? After Walmart's initial success in Rogers, Sam Walton opened more stores. By 1967, he had opened 24 stores, which brought in sales of about $13 million. The company reached $1 billion in sales in 1980, by which time it had 276 stores and about 21,000 associates. Note that store openings and selling more products through the same stores propelled growth from 1967 to 1980. During these 13 years, sales per store had increased about 7 times. How had Walton done this? By continuously trying new things, expanding product offerings, and broadening the customer base. Not all these experiments were successful. For example, in the early 1980s, Walton started 2 hypermarts, giant stores selling groceries and general merchandise, in the Dallas-Fort Worth area. But the concept failed. He also experimented with discounted drugs, discount drug, and home improvement, Save More, both of which shuttered. One of his experiments, however, worked spectacularly well. Sam's Club, focused on retailers who buy in bulk, was launched in 1983, and within a decade, it had crossed revenue of $10 billion. The spectacular success of Sam's Club demonstrates the slight downside and colossal upside of taking manageable risks. As discussed in Chapter 1, most M&A fail, and the larger ones can destroy a business. Walmart has managed acquisitions the way they should be managed. It has kept targets small and manageable and funded them without taking on large debt. The company made its first acquisition 15 years after inception. It was close to $500 million in sales, and by this time, as is evident from his autobiography, Sam Walton was feeling quite confident about the future of the business. Even then, he behaved prudently by acquiring a small discount store business called More Value in 1977, which was about 1/10 the size of Walmart. As he says in his book, we closed 5 stores and converted the remaining 16 to Walmarts, and it wasn't much of a shock to our system. By 1991, Walmart was present in 49 states, and the management started exploring options outside their home country. Almost 2 decades after the first store's inauguration, Walmart embarked on its maiden international foray by entering into a joint venture with CIFRA, Mexico's largest retailer, and by 1997 it had acquired a majority position in CIFRA. Was this a neutral change? It sure seems like one. In hindsight. The Mexico joint venture started small and would not have impacted Walmart's U.S. operations. Also, a joint venture in a foreign country allowed Walmart to dip a toe to check the water temperature. Once the company had adjusted to the new geography, it felt confident in making a bigger commitment by acquiring the rest of CIFRA, starting from scratch in 1991. Walmart's revenue from the international segment in 2020 was $120 billion, or 23% of company sales. The company did something similar, small, measured, and low risk when it launched its web business. In 2000, Walmart joined hands with a leading Silicon Valley investment firm, Accel Partners, to launch Walmart.com. Accel, by the way, gained much fame and a gargantuan fortune as a result of its $12.7 million investment in an early-stage company called Facebook in 2005. In about 18 months, in mid-2001, Walmart acquired the minority stake of Accel to own Walmart.com fully. By 2020, Walmart's e-commerce sales had climbed to $24 billion and Walmart.com was approaching 10% of Walmart's overall U.S. sales. What had started as a neutral strategy in 2000 is now fast becoming the centerpiece of Walmart's approach to gaining market share. One of our largest investors is a well-known U.S. university endowment. They have been investing in funds globally for many decades. Their CFO visited our Singapore office in 2011. After he had finished grilling us on compliance and other related matters, I wanted to know if he could share any learnings with us. He said that the one industry in which their fund managers had consistently lost money across time and geographies was retailing. In this context, Walmart's success is awe-inspiring. And how robust was Walmart at the end of 2020? Let me point to just 2 indicators. Its return on tangible capital employed was 46%. Thus, for day-to-day operations in 2020, it deployed $49.7 billion capital to earn an operating income of $22.9 billion. Its net debt level was just $26.8 billion, substantially lower than its equity value of $52 billion and EBITDA, earnings before interest, tax, depreciation, and amortization, of $38 billion. Its continued robustness has helped the management take calculated risks in the United States as well as across the globe. I don't want to pretend that Walmart's success is solely the result of its slow and steady approach to growth and expansion. Walmart has undoubtedly flourished for many reasons. Apart from Sam Walton being the founder, though, I don't know what other factors have led to its success. I can rattle off a list of things from various business books and articles written on Walmart, but I don't know if they were the cause or the effect of its success. But I do know that taking calculated risks and staying robustly healthy have had a strong correlation with its accomplishments over 60 years, as it has been for almost all the Nalanda portfolio companies. When we first invested in Page Industries in 2008, it primarily manufactured and sold men's innerwear. Here are some of the milestones and neutral strategies implemented by Page since then. 2008-09, primarily a men's innerwear company. 2009-10, launched women's leisurewear, men's sportswear. 2010-11, first store for women in Delhi, first training center for production staff. 2011-12, boys and girls ranges, signed exclusive licensee agreement with Speedo. 2012-13, sleepwear range for women, men's performance stretch range, thermals. 2013-14, new international format retail outlets, seamless sleepwear for women. 2014-15, exclusive outlets in Dubai, Abu Dhabi. 2015-16, boys collection, 7 to 12 years. 2017-18, girls inner and outerwear, men's and women's athleisure. 2018-19, teenage girls range. 2019-20, first digital manufacturing unit with real-time production data. The remarkable aspect of this list is what it doesn't include. There are no acquisitions, no unrelated diversifications, no visionary plans to change the world, no financial engineering. Only measured risks. For example, in 2009-10, the company launched men's sportswear. It did so through its existing distribution channel and staff, its current manufacturing units, and the same brand name. As the sportswear segment has expanded over the years, it now has its own supply chain, its own business unit, and its own advertisements. You will notice here that the company launched a children's range in 2011 to 12. Page describes this natural extension of the Jockey brand in its annual report. With the launch of Jockey Kids, the brand reaches out to the consumers of tomorrow. Keeping comfort as our topmost priority, we have brought in a range using 100% cotton, super soft, absorbent fabric for both boys and girls. As investors in Page, we were excited about this new target segment because it would double the Jockey brand's addressable market. After 17 years in India, Page had earned the right to extend its brand into a new segment. Unexpectedly, it failed. The children's range did not do well, and the company withdrew its products. Did this have any negative impact on the finance or operations of the company? No. This is because it was a calculated risk. It was a neutral strategy that did not affect the robustness of the business. Its operating ROCE in 2011 to 12 was 59% and was even higher in 2012 to 13 when it realized the children's range had failed at 64%. In 2012 to 13, overall sales grew 26% and profits rose 24%. In both these years, the company had negligible debt. The advantage of having a solid foundation that allowed it to take small bets was evident. Page went back to the drawing board and launched only a boys' collection in 2015 to 16. Even within this segment, it introduced products only for boys aged 7 to 12 years. Why not 5 or 13-year-old boys? I have no idea. I don't understand product marketing, but thankfully Page does. It launched girls' inner and outerwear a year later. By 2020, the boys and girls ranges had become a hit and had started contributing to the overall sales and profit growth of the business. What had started as a small experiment in 2011 to 12 was finally yielding fruit. As India went into a full lockdown in mid-March 2020 owing to the COVID-19 pandemic, the company's annual sales grew only 3% for the year ended March 2020. Profits fell 15%, but it delivered ROCE of 63% while remaining debt-free. This robustness, we believe, should allow the company to continue to take calculated strategic bets many years into the future. Robustness is a proxy for evolutionary and business success but doesn't guarantee it. Dinosaurs, a diverse group of more than 1,000 reptilian species, dominated our planet for 180 million years. As a matter of comparison, we Homo sapiens have been around for less than 0.2 million years. Dinosaurs couldn't have survived and thrived for so long unless they were highly robust and adaptable. Molecular evidence has shown that many modern mammalian orders, Carnivora, Primata, Proboscidea, coexisted with dinosaurs for at least 30 million years during the Cretaceous period, 145 to 66 million years ago and maybe even earlier. The mammals during the era of dinosaurs were small, squirrel-sized, and probably insectivores. If aliens had landed on our planet 65 million years ago, they never could have predicted that a small offshoot of the insignificant mammalians would reign supreme one day. The cataclysmic aftermath of an asteroid strike in the Yucatan Peninsula 65 million years ago wiped out the dinosaurs. But the mammals survived. No one is sure why. The extraordinary robustness of dinosaurs did not guarantee their evolvability. In general, the greater the robustness, the greater the evolvability. But sometimes robustness ceases to help businesses adapt. We can see this in Gap's failure to grow despite the company being very robust. Its revenues stayed flat at about $16 billion from 2005 to 2020, although it delivered ROCE of 20% or more for more than a decade and had no leverage. In general, multiple levels of robustness are better than a single level. But sometimes even multiple levels of robustness can't safeguard the future of a business, as has been the case for thousands of newspapers across the world. In general, highly robust businesses evolve by taking calculated risks. But sometimes, very rarely, businesses can succeed by taking huge risks, as shown by Netflix. We at Nalanda never bet against the odds. And so, despite some rare counterexamples, we have kept and will continue to keep robustness at the front and center of our investment approach. As permanent owners, we seek robustness in companies as the best available benchmark to assess if they are likely to adapt and survive over the long term. A better measure may exist, but I don't know what it is. We invest only in highly robust companies. Many of them have stayed robust and have grown their sales and profits over decades. But our track record is not perfect. We have witnessed two key problems with this approach. First, a business can lose its robustness. We saw this happen to one of our consumer-focused companies. We still don't know how or why it lost its way. We invested in this business almost 20 years after its creation. During that period, the management had built the largest brand in its industry in the country. When we invested, the company had no debt, its sales had grown 20% annually for the past 5 years, and it had delivered ROCE of more than 50%. Within a few years of our investing, the company's inventory and receivables started climbing steeply, a leading indicator of potential sales issues. While the company continued to show profits, it had begun consuming cash while having been a cash generator in earlier years. As a result, it had to start borrowing money just as its ability to repay the loans declined. Being a permanent owner, we are tolerant of declining sales or margins or market share, but we will not risk survivability. As the company's robustness nosedived, we exited the business at a loss. The company survives but is a pale reflection of its former glory. This unexplained decline of robustness has occurred in our portfolio only once since our inception in 2007, but it has happened. The second problem is too much robustness. One high-quality business in the Nalanda portfolio has been too robust. It has been unable or unwilling to implement any neutral strategies to expand its customer base, product segments, or geographies. As a result, the company has grown its sales at less than 5% annually for a decade, and its profits have stayed flat during this period. To be fair, its industry has gone through a vicious downcycle, and this business is the only one among its peers that continues to generate profits and free cash flow, and it remains debt-free. It is also the only business in our portfolio that has taken robustness to its extreme by eschewing calculated risks. Maybe it is in an industry in which it can't or shouldn't. Perhaps when the industry upcycle arrives, it will finally see growth. Or maybe not. We will continue to remain owners in the business. While our returns have been positive, they have been below par. But I love them, they are a class apart in a very tough place. We are willing to sacrifice growth for robustness. We have made almost 40 investments to date, and in all of them robustness was a primary but not the only selection criterion. We have worked on the assumption that robustness will lead to growth and evolution. This assumption has failed us on 2 occasions, one in which the company lost robustness and another in which the company's excessive focus on robustness compromised growth. I am surprised at our strategy's low failure rate. We have been quite lucky, and while robustness should continue to reward us across our portfolio, we will continue to encounter failures of the first or second kind over time. The only way to protect against loss of robustness is entry valuation. Confronted with a like challenge to distill the secret of sound investment into 3 words, we venture the motto, margin of safety, emphasis in the original text. This is the best advice for investors in the best chapter of the best investing book ever written. The Intelligent Investor by Benjamin Graham, Buffett's actual and spiritual mentor. The chapter is titled Margin of Safety as the central concept of investment. Graham knew that the corporate world is highly uncertain and that the best protection offered to an investor is the price they pay for a business. Another investment legend, Seth Klarman, offers the following advice in his book appropriately titled Margin of Safety. Risk-averse value investing strategies for the thoughtful investor, value investing, the strategy of investing in securities trading at an appreciable discount from underlying value, has a long history of delivering excellent investment results with very limited downside risk. In this chapter, I have used the word robust to extend the margin of safety concept to many other facets of a company. We have sought a margin of safety on business quality by demanding high ROCE and a wide competitive moat, on the strength of the balance sheet by requiring it to be debt-free, on the bargaining power of customers and suppliers by requiring them to be fragmented, and on the sustainability of economics by insisting that the industry be slow-changing. But even these multiple levels of robustness or margins of safety can become compromised owing to unpredictable changes in the economy, the industry, or the company. The COVID-19 pandemic has severely impacted what had appeared to be highly robust hotel chains. Intel's erstwhile dominance in semiconductor chips has been upset by the likes of AMD, Nvidia, and Samsung. Amazon has already destroyed many small and large retail businesses. Regulators in the United States and Europe appear to be threatening the very existence of Google and Facebook in their current form. We do the best we can to choose businesses based on their current and potential degree of robustness. But bad things will happen, we just don't know what, when, or how. And so we turn to the one aspect of investing that is entirely within our control: the price we pay. We know that given the nature of the businesses we are after, those with very low risk and exceptional business quality, they will almost never be available cheap. The market is not an idiot, it is almost always efficient. Almost always. Not always. We wait for those few occasions to pay what we call a fair price. Not too low but not too high either. What is fair? Rather than describe it, let me state the actual number. The median trailing 12-month TTM entry PE ratio for the Nalanda portfolio is 14.9. The median TTM PE for the period from 2005 to 2020 for India's primary index, Sensex, is 19.7, and for the mid-cap index is 23.8. Thus, we are buying what we think are exceptional businesses at a 25 to 30% discount on the index. Over almost a quarter of a century of investing, I know I have been wrong on many occasions. The margin of safety of our entry price pays for my errors of judgment. A leader is made a loser. Lazarus of Bethany was miraculously brought back to life by Jesus in the New Testament. Charles Lazarus performed a modern capitalist miracle by making Toys R Us the largest and most well-respected toy business globally. Lazarus is also a beggar in a parable in the Gospel according to Luke, the third of the 4 Gospels of the New Testament. Once a miracle of Lazarus, Toys R Us suffered the same fate as Lazarus the beggar. Charles Lazarus opened his first Toys R Us store in 1957. In that era, parents typically went to department stores to buy toys. Toy sales were seasonal, and the 6 weeks leading up to Christmas made up the bulk of sales for the year. Most toy stores were small family-run shops and carried only a small number of toys. Having operated a baby furniture business from 1948 to 1957 and learned the shopping habits of parents, Lazarus decided to risk a new strategy. He wanted to sell toys throughout the year and give parents and children a novel shopping experience. His first store was 25,000 square feet in size and stocked thousands of toy varieties. The store did not keep toys in display cases as did its competitors. Instead, it kept them in rows next to each other like items in a grocery store. The store was a massive hit given its size, variety, and low prices. Despite his initial success, Lazarus moved slowly at first and opened only 4 stores until 1966. In 1973, Toys R Us started advertising on TV using its store mascot, a cuddly giraffe called Jeffrey. Lazarus also began tapping Japanese manufacturers to make inexpensive toys and negotiated attractive rates for bulk purchases. The company went public in 1978 and grew at more than 20% annually for the next decade. Morgan Stanley's retail analyst compared it to the venerable IBM in 1982. I think Toys R Us is a unique operation, the only proprietary merchandise company that rivals IBM as revolutionary in concept. The Washington Post compared it to another iconic American brand, McDonald's, by declaring, like McDonald's, with its regimented service and standardized burgers and fries, Toys R Us has become an American institution. Toys R Us kept gaining market share by opening stores slowly and steadily. It did not get enticed by transformational M&A, although I am sure there was no dearth of bankers paying their respects to Lazarus every week. It continued, however, to take measured risks, one of which was the opening of a Kids R Us clothing store in 1983. The company also started expanding overseas and, in 1984, opened its first international stores in Canada and Singapore. In 1985, the company opened 5 stores in the United Kingdom, and in 1991 they entered Japan in an 80-20 joint venture with McDonald's. In the United Kingdom, Toys R Us captured a 9% market share in just 3 years. The company continued to expand in overseas markets after its initial successes. In 1988, the Wall Street Journal boldly predicted, Toys R Us, big kid on the block, won't stop growing. As if on cue, the problems started. In 1988, Walmart's market share at 17.4% came marginally ahead of that of Toys R Us at 16.8%. Toys R Us was in second place after being the leader for 15 years. Toys R Us was being squeezed at both ends by discount chains like Walmart, Target, and Costco, which competed on low prices, and by so-called edutainment companies like Zany Brainy, Noodle Kiddle, and Imaginarium, which offered higher-priced specialized toys and better service. In 1998, the company launched its website, ToysRUs.com, and its first mail-order catalog. But the company was struggling, and 1998 was the year of restructuring, which is usually the euphemism for a business terminating its science projects and loss-making initiatives. The company announced a huge inventory reduction, the closure of 59 stores in the United States, France, and Germany, the shuttering of 39 Kids R U.S. stores, and a layoff of 3,000 workers. The cost of restructuring was so high that the company declared its first net loss since going public. Too often, a business in trouble tries to buy its way out. Toys R Us was no exception. It acquired Imaginarium Toy Centers in 1998. It also tried frequent management changes. The company had 3 CEOs from 1994 to 2000. But its downward slide continued with Amazon, too, muscling its way into the toy segment. The company's sales stayed flat at $11 billion from 1997 to 2004, and the operating profit fell by about 65% during this period. The operating ROCE was 15% in 1997, and it fell to 4% in 2004. The situation was so bad that the company shocked the world by announcing that it might completely withdraw from the toy business and focus on the Babies R Us chain. Okay, let's pause here and summarize the situation in 2005. Toys R Us was spectacularly successful for about 4 decades, from the late 1950s to the late 1990s. By the mid-2000s, however, it wasn't growing, its market share was declining, and its profitability had taken a severe beating. Whatever the reasons for its trouble, there was no doubt that it was in trouble. The company's robustness had suffered significantly. Maybe it was bad luck, maybe it was management missteps, or maybe it was a bit of both. One way to think about this situation is to picture an elite marathoner whose performance has dipped in recent months. They used to be a picture of health and vigor, but nowadays they look exhausted and cannot run even 10 kilometers at their earlier marathon pace. They are now at the starting line of the Boston Marathon. What would you expect their coach to do before the race starts? If I were the coach, I would advise them to withdraw from the race, rest and recover for a few months, and slowly build their mileage back up. Maybe your advice would be different. You might counsel them to take it easy and just finish the race without worrying about a podium finish to minimize damage to the body. I assume you would be shocked if I told you that the coach not only asked them to run at full speed but also loaded a 10-pound bag on their back. Yet this is what happened to Toys R Us. In 2005, the private equity giants KKR and Bain and the real estate firm Vornado purchased Toys R Us for $6.6 billion. However, their equity contribution was only $1.3 billion, and they borrowed $5.3 billion for this purchase. And then they loaded this borrowing onto Toys R Us. If you know nothing about the leveraged buyout LBO industry, you may be rubbing your eyes in disbelief. The private equity folks bought Toys R Us for a fat sum of money, borrowed 80% of that amount, and then burdened the company with this borrowing to finance their purchase? Oh yes. Welcome to the wonderful world of finance. While leverage may be good from a corporate finance perspective, it is bad from my point of view. But I hope all parties can agree that it is terrible for a struggling business. The elite but sick Toys R Us marathoner had just been asked to run the Boston Marathon, competing with world-class runners with a 10-pound load on its back. Remember that the capitalist world is a Boston Marathon that never ends. There's no respite at the end of a punishing 2-hour race. The race goes on and on and on and on and on. 24 hours into 7 days a week into 365 days a year. It's unending, unrelenting, unforgiving. The massive debt load meant that by 2007, 97% of the company's operating profit was consumed by interest payments. Where was the money left to innovate, invest in stores, advertise, hire and train the best people, and do all the things any business needs to do to stay on top of their game? In an Atlantic article on the failure of Toys R Us, an interviewee remarks that the company was handcuffed and could not make investments. Another one rightly points out it's true that they could not respond to Amazon. But you have to ask yourself why. Catherine Waldock, a finance professor at Georgetown University's McDonough School of Business, said in a Wall Street Journal article the $400 million a year in debt service was really constrictive as they were trying to compete. Toys R Us was already unrobust at multiple levels, and the additional leverage taken by its private equity owners proved to be the last straw. The company filed for bankruptcy in September 2017, and David Brandon, the CEO, candidly admitted, The company's overleveraged capital structure has constrained it from making necessary operational and capital expenditures, including investing in the revitalization of stores. As a result, the company has fallen behind some of its primary competitors on various fronts. You don't say. Toys R Us bought the FAO Schwarz business in May 2009. Both companies had been struggling against discount retailers and web-based sellers like Amazon. Most acquisitions compromise the buyer's robustness, and for an already weakened company like Toys R Us, the probability of success is even lower. Unsurprisingly, it closed Manhattan's iconic FAO Schwarz store in July 2015. And left me distraught. Dear Amazon, you have opened physical bookshops in Manhattan. Time for toys? Chapter Summary. Evolutionary theory has taught me that we can reimagine investing by owning only robust businesses that are resilient to internal and external shocks while continuing to evolve and grow. 1. There is a paradox in the living world. Organic life is highly complex but not fragile. Organisms have survived hundreds of millions of years despite living in constantly changing external environments and undergoing a barrage of internal mutations. This is because they are robust at multiple levels. 2. Thus, an accidental change in DNA sequence does not affect which amino acids are made. A change in amino acids or their sequence does not impact the synthesis of proteins, and a change in proteins need not affect the body plan of an organism. 3. Neutral mutations permit new functions and adaptations to arise without disrupting current functioning. 4. We want our businesses to mimic the robustness of the living world. To survive and prosper in a dynamic external environment, withstand internal strategic and organizational upheavals, and evolve by taking calculated risks. 5. Hence, we choose to invest only in businesses that are robust at multiple levels. A robust business has high ROCE, minimal or zero debt, a strong competitive advantage, fragmented customer and supplier bases, a stable management team, and is in a slow-changing industry. 6. Just because a business is robust today does not mean it will continue to be so. Our only protection against the loss of robustness of a business is to be price sensitive. We do not invest unless the market offers us an attractive valuation, which happens rarely.